Hi there, traders. This is Brad Gilbert with today's trading action. All right, now just on the US equity futures, they're slightly up. And we're seeing a bit of a risk on day, risk off. Not really, right? But it's no surprises because there's very little movement in the major currency pairs. And that's primarily because we have the US non-farm payrolls data coming out today, right? So some key data to look at. I'll come back to that in a second because what you want to do first of all is just isolate the best trading opportunity. Okay. And what I'm talking about there is isolate where the direction for these instruments. Now, the dollar to me is starting to break down, and this is it's got the feel of a medium to longer term move. Now, dollar Swiss lower. We have seen it or heard from the Swiss National Bank that they are pretty pissed off with the weakness in the Swiss. So we are starting to see a bit of a move down there. The dollar yen cruising topside, but now there's no talk about yen and how high it is and these sorts of things. It's almost a time where it will start dribbling off, right? Dollar CAD still mid-range, and we have the Canadian employment numbers, so I can't see it going anywhere. But with US employment and Canadian employment at the same time, you're either going to get that double whammy where they both of them are strong or both of them are weak. If there's disparity in the data, then you're going to get some sort of chaotic move. Now, euro, sterling, okay, Aussie and Kiwi, this is the daily charts, all look primed to go up. Now, sterling is battling away here, trying to get through this, or through that sort of sticky barroom brawl area. Euro, they cut rates, but that was hugely forecast. As I was expecting, Christine Lagarde, the head of the ECB, is doing a good job. You know what? It's really going to come down to the US numbers to see where these things go. And Aussie just battling way through a resistance line with another one above, and same with Kiwi, right? So we've got levels. You're looking at the daily charts. You come back to the hourlies, and you can almost see it a lot clearer exactly where these levels are. Dollar yen sort of mid-range, as is dollar CAD. Euro slowly, steadily picking itself up off the floor. Sterling looks good. Aussie in a bit of a range, with the Kiwi still room for the top side, right? So what are we looking at here? To me, the way these arrows are going, it ideally suits a weaker dollar, right? Weaker outcome. Anything to do with weakness in the dollar here gives us a really good trading opportunity because it goes with the sort of short-term momentum and short-term trend, but it can lead to a bigger trend going forward. And that's what we want. That's what we need, right? It's almost like this isn't the best trading outcome for now. It's the best trading outcome for the next couple of months. Now, key numbers here, non-farm payrolls, the poll 185, the minimum max range 120 to 258. Excuse me. So ideally a number below 120 there is great for us. Weakness in the market. We get easy trades across the board here, sell dollars and buy the other instruments. Now, before you get all out of control, the unemployment rate is 3.9 with a range of 3.8 to 4. Okay, we want that to blow out a bit. Above 4% is our key number. Now, don't forget, there are a bunch of numbers here as part of the US numbers, right? And this is why trading the non-farms, especially using pending orders, is extremely problematic because you can get one number that's a little bit stronger, okay, and the other number weaker. You get that whipsaw price action and everyone's cleaned up. So just be careful. If you're looking to trade, either trade live or if you're using pending orders, put them like 20 points away, right? Because you don't need to get in close, because if they both line up, you get a weaker unemployment rate or a blowout and a weaker non-farm payrolls, well, then it's going to move and you don't get caught up in the initial volatility. Ideally, look to trade that live. Don't forget, we do have the Canadian employment numbers, right? Every second month, these two numbers come out at once, and it's a calamity, right? Because the Canadian numbers on their own are a good opportunity, just like the non-farms, but they're better because there's less data to be looking at, really looking at the change and the unemployment rate. Okay, so these two numbers here, you've got the ranges there. Now, if there's a big change in the employment change, just keep an eye on the full-time component because that's more important. It's more structured. superannuation, healthcare, like everything's built into that. Part-time stuff, well, there's not that's pretty fickle, right? So the full-time employment does come into play. So as you can see, like looking at all these numbers, trying to trade, say, dollar CAD can be hazardous at best. I have seen it where you get weakness in the US numbers and you get strength in the Canadian numbers and it goes gangbusters. But you know what? Where they are in the economic cycle isn't too far apart. So I can't see that happening. So try and keep it real. I wouldn't be sort of saying this is a great trading opportunity, primarily because there's too much risk around the entry levels and the volatility and the slippage that you can see on big variance here, right? I know a lot of people talk about it, but it's, as a risk manager, you're taking a backward step, let the numbers come through and then trade the opportunities, right? And what you can do there is the good situation we're in at the moment. Okay, if I just change the pen over, we have a situation where, yeah, we've got levels here on the hourly charts, right? All these hourly charts, and you may not have any sort of levels here to get in. And you're thinking, well, if I don't get in on the number, we're not going to be doing that well. But I can tell you, if you flip your charts over to the daily charts, you can see the dollar index sort of breaking down. Dollar Swiss has already left the building, but we have opportunities here on Euro, definitely Sterling, Aussie, and Kiwi, to say the least. Now, dollar CAD, well, just be careful, right? Because we are seeing, oil sort of whip around the place a fair bit. And it's sort of mid-range, so it's not awesome. But I'd say weaker numbers, we might start to see dollar yen tweak down as well, come into play, right? And I think that's the case because it's just so quiet. And that's when usually these moves occur. And I'm not talking about BOJ intervention. I'm just talking about natural flow, dollar weakness in the market. And this comes back to last week, when we were sort of looking at the markets and in particular focusing on the yields, okay, US Treasury yields. They've come off significantly, right? So this tells me, I think that could have been the top. How do we know? We get weak numbers, weak inflation numbers in particular, but they're not out today, right? So our indicator today is the non-farm payrolls. So focus on that and make sure you don't overtrade it. The idea is to get a trade in play here if you can, and just be careful. Like, don't come sort of crying to me if we get really weak non-farm payrolls and a much better unemployment rate, like 3.7, and you get a massive whipsaw in the markets. Well, you're going to get flogged. So just be careful as you go through that. All right, guys. So, non-farm payrolls, not the best, but keep an eye on it because it will tell us where the dollar's going from here. Good luck and happy trading.